Hi everyone, good afternoon. So this is a family office themed event, as you all know. Family offices basically sort of have their exposure across equity market, obviously, alternates, and then safe havens. This panel is all about safe havens. We'll try in the next 25 to 30 minutes, we'll try and understand what safe havens are. Has the concept sort of evolved over the years? There are newer elements, newer asset classes and structurings and financial instruments available to sort of have defensive play, and what fund managers and we have an amazing sort of panelist, what they are doing to sort of have a defensive play in their portfolio. I want to start with you, Anoop. If you can sort of, for us, we broadly understand what safe haven sort of do for a portfolio, but if you can explain to us in terms of what it is, and have we sort of evolved in terms of, what asset classes we have, what instruments we have, or we are only sticking to gold, bonds, and cash, which traditionally have been the defensive play for family offices?
Hi, good afternoon, everyone. So in our scheme of things where we manage the family office money for a single family, largely it is driven by the investment policy statement. For us, the safe haven is something which we can liquidate in a definite period of time without taking a hit on the mark-to-market to the extent possible. And hence, the assets under the safe haven or in the safety bucket has to be created over a longer period of time. So for us, it's largely AAA category debt assets and also the gold, which we have been adding over many years of time. This is something that in case of urgency or immediate funds requirement, what we can liquidate in a week's time to meet our urgent obligation, that we consider as a safe haven.
So what are those? You mentioned gold. What are the other elements that you have?
Okay, so as far as quick liquidity with safety is concerned, we consider gold and AAA category assets.
Okay.
We don't invest much into the liquid funds and the money market funds because the returns are really low. But these two categories on the liquidity perspective, and from a medium to a longer term perspective, I think even the equities become a safe haven because it would have passed the periodic test, right? 3 years, 5 years, where mark-to-market would have emerged. So that also works as a safe asset or a safe haven. So it actually depends on what family's asset allocation is and basis as to which asset has become part of safety bucket because of liquidity and mark-to-market. That decides the safety bucket for each family specific.
Sure, understood. Siddharth, I want to understand from you, he mentioned about a couple of options, but do you see like there are concepts and instruments sort of evolving to give the defensive play that family offices need? For example, let's go beyond gold, let's go beyond bonds, let's go beyond cash and understand if we have multiple instruments now. For example, AIF is there, then we have InvITs, we have REITs, and there are many across asset classes. We are not getting into the equity market, public equity market, but to stick to private market, what are the options we have and how are we sort of expanding this horizon in that sense?
So I think it's a known fact that over 80% of Indian households have some kind of property dispute. And because it's been the favorite asset class for most traditional families, and it's not liquid, it's difficult to divide, it's difficult to, a lot of operational challenges. Just by show of hands in the audience right now, how many people have exposure to real estate as an investment, not your primary house or office? Okay, so most people. And I think we've all heard either with ourselves or with our friends and family relatives that we've had issues with property rights and a lot of logistic paperwork. So I think the smarter way, if you're looking for that safe haven of real estate and want to play it, if you can look at REITs and InvITs, which is a great asset class because it provides multiple kind of flexibility options versus buying land directly. One, your ticket size is flexible. You can start with small checks, whereas a direct piece of land, the minimum you'll have to dish out is a sizable chunk. There's liquidity. If I own a plot, I can't sell half of it or 1/4 of it. But when I own a financial instrument like an InvIT or REIT, I can sell half of it. I can sell 1/4 of it. I can sell 10% of it as and when I need liquidity. It's also more tax efficient. So I'm a big fan of playing, if you must play real estate, of doing it through smarter ways, like financial instruments that exist today, other than directly exposing yourself to land.
But just to understand that these are like fairly new concept, right? They have come around in the last 5-6 years. What was the situation earlier? What was your thought process? Or I think we had the first REIT in 2018. I think what was the exposure like prior to that?
I think even before that, there were other ways to invest your capital if you're looking for safe havens. You mentioned gold and silver, and that's known. But what's not known is if you want to play real estate, there are blue chip real estate companies on the stock market that you can expose yourself through their portfolio. And that always existed way before REITs and InvITs even came out as an instrument. So instead of buying, say, a top tier developer, for example, would be Oberoi Realty, right? But instead of going to Goregaon, and it's further from me, and to select a plot out of the multiple buildings, find a seller, know that it's the right price. If you have bought Oberoi Realty stock a decade ago, you'd be a very happy person today because it's compounded at high double digits, and you have exposure to his entire projects then.
So you are saying exposure to a listed real estate developer is your defensive play in a volatile environment?
Absolutely. If you pick the right, of course, there's some intelligence you have to do. A lot of cricket promoters, but you can see some patterns when you're picking real estate promoters to play their stocks. Is ones that really don't go pan India too fast. Oberoi is focused not just in Bombay, in fact, mostly in Goregaon, right? You can say the same for DLF. They've made a fortune, arguably the largest real estate company in India, and their entire focus has been Gurgaon. More than 95% of their portfolio is in Gurgaon. So I think these are good things, traits to look for. Of course, you can study their balance sheets and see the historic track record. It's a bet on the promoter. Each project is a company in itself, so you can't go into analysis paralysis by studying that deep. But I think it's a smart idea. Even right now, if you see valuations for real estate listed companies, if you look at Godrej and you look at the good high quality names which we all know, I think if you make a basket bet there, I like that approach. So I think that's superior to buying independent land parcels.
Sure, understood. Sravan, what is your take on real estate? He's vouching for InvITs, REITs, and taking exposure through an indirect route as against buying a land parcel or taking a building or couple of floors in a building. What is your take? How do you sort of view real estate in the overall hierarchy of a defensive play from a portfolio point of view?
So I think the way large promoters have started looking at real estate has changed significantly, especially after 2018, like you mentioned, after REITs and InvITs getting listed.
Can I request you to be slightly louder?
Yeah. So the way the promoters have started looking at this asset class has changed, right? Because I come from a city like Hyderabad where real estate has been one of the biggest asset class for investments as far as family offices and promoters are concerned. So what has changed is previously the idea for the previous generation of promoters was to just buy land parcels across the city, expect that as cities develop, as the economy grows, your real estate will start delivering multiples for you, which has actually worked out very well over the last couple of decades. But incrementally, people have become smarter. People have realized that the bases have increased, right? The differential between a city like Pune, Hyderabad versus Mumbai has come down drastically today in terms of land prices. So today, the two ways one can look at investing into real estate from a family office standpoint is, the first thing is a bit more nuanced approach where, promoters do buy lands but don't buy it just to hold on to it for multiple generations. They would want to sort of eventually partner with some of the better developers out there and build an asset which is eventually a REITable asset, right? Which would end up giving an 18 to 20 or 25% sort of an IRR over a period of next 5 to 8 years. So the change is that they have a very clear target as to why they're buying a land, rather than just buying it just to hold because the economy will go and eventually the prices would go up. So this is one approach, but I'm sure not a lot of promoters are that savvy enough to sort of get into development risk today. So from that perspective, the easier and the better way to invest, like Siddharth has mentioned, is REITs and InvITs. I think from a liquidity standpoint, from a tax standpoint as well, they're extremely efficient. So that way, REITs and InvITs are by far the best asset classes for promoters to sort of take exposure to. Coming to your point on having individual floors in buildings, and then you have a lot of AIFs today. So each of these assets each of these investment asset classes have their own risks involved, right? Which you don't have in a REIT. Say, for example, you have a very high concentration risk. Then if you were to invest in AIF, of course, you need to ensure that you're getting that much more return over a REIT for you to sort of get incentivized to invest because it has 3 to 4 more layers of risk that a REIT doesn't have. One, we spoke of concentration risk. Second is a liquidity risk. And liquidity risk is again of two sides. One is where your capital is locked in for 5 to 6 years, right? Unlike investing into a REIT, which is extremely liquid, where you can liquidate in a day's time. The second part is the liquidity for the fund itself, because the fund eventually have to exit from those investments, and for them to find buyers is becoming challenging. We've seen that in the past as well. So that is the other aspect. And the third aspect is that, you have a key man risk. End of the day, you are relying on the fund manager, the CIO to sort of give you the exit after 6 years. So that's again a risk that we have. So keeping in mind all of these things, I think if you're still able to generate that kind of extra alpha over a REIT or InvIT, then I think you can still consider AIFs. But owning single office spaces, or owning a particular mall, I think it's quite difficult for promoters to sort of manage it over a period of time.
So what will be your preference in terms of, let's say, owning an asset directly and then AIF and then REITs and InvITs? If you can give us a sequence and how that has sort of changed.
So for us, at least, REITs and InvITs are the first priority. I mean, we've built a large portfolio there, and we continue to add significantly into that space, because we believe that, from a risk-adjusted return basis, not just an exposure to real estate, but even across all asset classes, we believe that that space is quite attractive. So that's the first preference. Maybe the second preference could be AIFs, because we want to avoid owning physical assets, because that becomes too much of a hassle for a family office to sort of manage, unless you are full-time into it, right? So if we were to have a pedigree of real estate, then it's a different story, but unfortunately we don't. So we might eventually prefer a bit of AIF exposure to diversify, but predominantly the exposure would remain in REITs and InvITs.
Sure, understood. Gaurav, if you can explain to us what you have done, you can touch upon the fixed income part of the overall play, how that helps, because you have credit funds, you have fixed income funds, which give you regular income, and, some funds also give you a little bit of equity kicker if that is sort of, part of the charter of the fund. You can touch upon that and also explain to us what have you done to your defensive play in the wake of volatility that we have seen in the market. I mean, there is a flight of capital to safe asset classes in a market when it's kind of volatile and sort of, lot happening. We all know about that. What have you done to your portfolio to keep it like, preserve, like we say, the wealth first, and then beat inflation second, and then see if there is a little bit of return that we can generate? Give us the tweaking for people to understand.
Because the topic is very interesting, real safe haven. And when I say real safe haven, I think three things came into my mind. As Anoop ji mentioned, preservation of capital, then liquidity, second, and
little
third.
bit louder, that will help.
The first is a preservation of capital always. The second is a liquidity. And third is the asset class should beat the inflation. But the sad part is none of the asset class actually match all the three criteria simultaneously. That's the hard reality actually. Where we talk about lot about, but that is the hard reality. If I start thinking about liquidity to get any time, I just put money into the liquid money market instrument where I get my liquidity T+1, I will end up losing, you can say, my purchasing power. Second, safety is there, definitely is there. Let's say if I put money into maybe the real asset, so-called real estate, where I can get maybe the double-digit IRR, the liquidity is not there. And mind you, all the asset class have the cycles. Real estate is also the cycle. People have become gung-ho of real estate in the last 2-3 years, but for 10 years, real estate delivered almost zero return.
Yeah, correct.
Okay. I think Siddharth was talking about real estate equity. I may not be, you can say, comfortable actually to buy real estate equity actually.
Good to hear a different view, because for a long time it didn't really work. I mean, from 2012, 13 till...
For 10 years actually,
for 10
it didn't
years.
deliver return, any kind of a return
Correct,
actually.
yeah.
Every asset class have a cycle. And when I talk about, you can say, durability, for me, one thing is very clear. The resilience of the cash flow generation is very important. And durability of this cash flow. When I talk about these kind of instrument, which is precisely mostly illiquid in nature.
What are those instruments? Tell us what are those instruments that are generating cash?
REITs came in the market is just 5-6 years ago.
Exactly,
right?
my point, yeah.
Now people was putting money into REITs and InvITs, is fine. But at the end of the day, you need to digress, you need to dig dive basically the particular asset underlying holding basically of these REITs and InvIT. There were two components of the IRR. People are saying the mid-teens kind of an IRR, 14-15%. How much is coming from the regular cash flow? every time you cannot focus on growth. Growth ke liye I have a private markets actually are there, which is itself is illiquid in the nature. When you're putting money into REITs are also not as liquid. Yeah. And they have market cycles. If the equity is not performing well, I have seen the REITs as down 20-30%. So it's all cycle. No, your effective yields become lucrative actually when the prices has come down. So it's very, very difficult. As I mentioned, three things basically. You can, I cannot find if somebody can, you can say, give me any example of any particular asset class if all the three criteria can be met. I don't think so.
Okay.
So it's very difficult actually. What I have done in last, I would say 3 years since 2023 onward, I focus more on a cash flow generation part of the portfolio. Today, close to 30% of my portfolio is more into the regular cash flow stream basically. So my duration risk is keep coming down. If I'm putting 100 in somewhere, at least I'm getting 7, 8, 9 rupees at least every year.
Okay.
So which every passing year, at least my capital risk is keep reducing. Rather than you can say just teasing on a growth. Because real estate itself is a big risk, as I mentioned to you. REITs, then InvIT. InvIT again itself is illiquid in nature. So REITs have a slightly lower risk because these are the matured assets. When you go for InvITs, these are immature assets because you're in developing phase. So most of the returns will come basically on the growth rather than to getting the regular cash flows. So first I will priority REITs, then InvIT, but again, safety of the principal please is not like that because you can just put the money and you will keep getting, no, it's not like that. Gold, one of my favorite asset class, not because of recent returns, look at the return of the generations actually. Look at return of last 25 years, compare with any indices, it's been outperforming. There is something wrong in the financial system. That's why basically this gold is continuously, is proven wrong, all the so-called fund manager, all the so-called, market veteran and all. So it's very hard to find out actually, all I would say. You just need to, build your own thesis, where your portfolio fits actually, and then take a call on that basically. So I cannot, just give you any specific answer on that basically, which this asset class particularly is fully safe. No, then put money into
But what are the few options, if you can quickly summarize that, what are the few options that you sort of prefer against others?
Gold would be the first priority.
Okay.
And second, any asset class which is giving me a decent cash flow on a regular basis.
That's what I'm saying. So when you say cash flow, you mean credit funds, you mean the debt funds?
REITs, InvIT,
Okay.
and credit fund have a very variety of the credit funds.
Mm-hmm.
It could be from highly AAA bond, it could go up to structured debt. So I need to think about basically where I'm comfortable.
Sure.
So starting with gold, let's say go to REITs and InvIT, they are listed at least. You know basically what kind of a quarterly distributions you are getting.
Sure.
And then go up to maybe private credit or AIF, I think, mentioned basically, because some of the assets, some of the people are basically just pooling the assets into AIF. And they will be likely to go into further maybe 12, 24 months down the line, go to REITs and InvITs.
Sure.
So that would be, is bucket
Understood.
of that.
We'll let Vikas also sort of speak. He's waiting for his turn. So what is your thought process when it comes to building a resilient and defensive sort of portfolio? And give us some sense, people have given their preference in terms of asset classes, but what have you done to the portfolio? I mean, these are part of a regular portfolio, like for family offices, right? But depending on the situation, I'm sure the allocation changes. What have you done to sort of make it more resilient in the recent times?
Yeah, I think interesting discussion. Thank you all the panelists. In fact, much of it has been covered in a way. So I will just give you a couple of frameworks which we use at our family office advisory level and also a bit of schooling. Pardon me. Gold, I think everybody has talked about, but has anyone thought why gold? Why gold is a safe haven or safest of haven? It becomes very popular because everybody says gold, but I will give you a schooling part of it. So Aristotle in 400 BC said 5 things about gold, which is divisible, indestructible, convenient, and store of value, amongst many other things. So any asset class which fits these criteria is real money, and money is what is safe haven basically. That's why gold comes into picture of all of it.
No counterparty risk also.
No counter, because it's a store of value on its own. I think Gaurav made a very important point. What is a safe haven? Safe haven is an asset which doesn't have any encumbrance risk or a counterparty risk.
Sure.
Sorry to say, you might all be carrying currency notes in your wallets. That is a counterparty risk. RBI governor has given, I commit to pay you. Still some bit of risk, though it's a sovereign risk. But any other financial assets, generally speaking, is a liability on someone's balance sheet, be it equity, be it fixed income. Safe haven typically gets to assets which are unencumbered, and that's why they are treated as real money per se. So gold will be obviously in a framework like that. It's an insurance. I think a couple of our earlier colleagues said about that. It's an hedge. It's a tail risk hedge. Again, a bit of schooling. Go back to Great Depression 1929. 90% decline on financial assets. Gold declined by 10% or gold miners declined by 10%. Now imagine you are having that. You are 82% against everybody else. You have that purchasing power by which you can buy anything which is now available at a 90% discount. That's the real safe haven part of it. The other aspect, I think, because we are talking of real assets, how we think of it is in a framework is quasi-fixed income. After the taxation event in 2022-23, post-tax returns on fixed income really became a bit of question mark. How we look at that is, can we have an asset class wrap, which is quasi-fixed income, which takes care of real cash flow backed? I think Gaurav had a very important point. Asset backed, cash backed assets, which play a role of giving you equity type returns at a fixed income type risk. Okay. Right? I think one of the areas which we might probably not have covered is regulated utilities, for example. Okay. Right? They are levered, but they give you regular cash flows. REITs, InvITs, private credits, structured credits. How you structure obviously is a different thing. You don't want to maybe go to special situations, go to a performing credit. But that gives you a quasi-fixed income with relatively safer approach kind of a thing. And the third element to round all of it, which we consider as safe haven or as, safety first, is a really robust all-season portfolio approach in your asset allocation, which is have 3 or 4 asset classes round the clock, absolutely uncorrelated. That's how it will play out. When 1 or 2 asset classes are going through a weak cycle, I think, as Gaurav mentioned, because cyclicality is a risk with almost every asset class, the other 2 probably will protect your purchasing power. And if you put together a robust all-weather portfolio, I think asset allocation-wise, it would have done the job.
Sure, understood. I'll come to you, Anoop, again now and try and understand. See, there are downturns in the market, and there is, in the last few quarters, what we have seen, there is a lot of volatility, and, one statement by Mr. Trump, and the market goes up and down, and all of those things are happening. At what point the needle moves for you? Like, is the portfolio allocation sort of determined by the broader charter of the family office? And I'm sure you react to the situation and the market and, what happens in and around across the world. But at what point the needle moves and you have to say that I have to pull out money from this portfolio and sort of, give to this particular asset classes which will sort of be long and have a defensive play? What is that point?
So for us, it's the other way around actually. Okay. So what we have done is we have put the maximum effort on designing the IPS, which is the investment policy statement. And the IPS defines the asset allocation. Once you have a right asset allocation that suits your risk appetite and the aspirations, then once asset allocation is done, you don't need to every time look at the global situation, because you have already taken that call that things will be volatile in this kind of markets and the cycles are becoming small, right? So earlier the cycles which used to be for a decade became 5-6 years and now for 2 years. I mean, just to give you an example, like 2 years back, I think the entire investment industry and people were very much bullish on the India markets as far as listed equities is concerned. And now we have seen what has happened in last 2 years. And today the entire country or the world is running after the dollar asset. So there are cycles. Once you have the right allocation, then you can sit peacefully and keep on reviewing the investment policy statement on a periodical basis. Now that periodicity can be 1 year, 2 year, what we do is we do a soft review of our IPS on every 6 months, and we try to do at least one serious review every year. And in case there is a need for reallocation or reshuffling in the portfolio, that's what we do in a year's time.
I understand your point. You're guided by your charter. What I'm trying to understand, what happens in the market that will force you to sort of shuffle and reshuffle your allocation,
No, so
or you are like guided by whatever we have written in our policy framework. We'll be guided by that no matter what happens around the world. At what point that kind of needle shift?
So
How big the
we
event
have
should
been
be?
investing a bit differently. We are not very active in investing. So what we have done is we have chosen best advisors from the wealth side, and we have led that job of deciding the best asset and best scheme to them. And since we are a passive investor, we don't really like to get into a situation where we have to have a palpitation every now and then because Trump is doing something. If that happens, then obviously that moment has yet not come for us. If it comes, we'll see the situation. But one more thing is where there is a lot of talk about REIT and InvIT. I have been closely monitoring it. We have a very small allocation, but I believe this asset is a matured asset, and I mean in terms of industry, it has matured, and it's very safe to invest in this asset class because it gives a lot of liquidity, safety to a large extent, and also it is tax efficient. So a combination of
Sure.
liquidity, safety, tax efficiency with a higher single-digit post-tax return is not a bad asset class to consider. So I have been focusing more on these kind of asset classes, which we'll introduce whenever we have new money to put in.
Interesting. I think the REIT owners will be very happy to hear that. Anyway, so my next question is about diversification. I mean, we are talking about everything, REITs, InvITs in India, but you spoke about how you like the REIT InvIT framework more as against direct ownership. You also said that the equity listed and good quality stock is something that you'd prefer. But what about global participation? I mean, people sort of own trophy assets outside, offshore, and that also works like a big part of family offices portfolio. What is your sense there? I mean, are there geographies? For a long time, Dubai was considered safe haven, so to speak. What has happened to that now because of the geopolitical situation? So give us some sense on geographical diversification and what happens. Are they really kind of immune to different volatility in the market?
I think that's a very good point. I think I'm a fan of diversifying, especially geographically, because you never know what's going to happen. There was no better, safer haven than Dubai, untouchable, right? And look what happened. The prices have almost half now in a lot of places. And before that, when the Russians had come in and real estate prices were skyrocketing during COVID, we all thought we'd missed the boat. But nobody wants to buy now that it's half off. So I think whether it's stocks, whether it's real estate, whether it's startups, you have to understand cycles, and the time to buy is when there's blood on the streets. Warren Buffett's famous for saying that. But it's about original, contrary thinking. Sometimes in the biggest crises, you can find gems. So I'll give a great example. In 2008, we all have, either some of us been there and some of them read about the great real estate crash, right? Economic crash led by real estate. Now, in that same year, what if I tell you the greatest startup, not just the greatest real estate startup, but the greatest startup period probably was born? Any guesses which company I'm talking about? It's a US-based real estate venture capital funded company, market cap of north of $100 billion. You want to scream it out? You're saying it. I can see you lip it, Pearl. Go ahead. Please give her an award because she's bang on the money. First guess and right. Airbnb was born in the midst of the greatest real estate crash in the world, and it's a real estate company. So I think we should be opportunistic. They were rejected by dozens of VCs. It's not surprising that a VC is answered the question because never let a crisis go to waste. So I think right now, Dubai could be something to look at because we're going through downturn, but it just requires contrary thinking.
Okay, buy when there is a dip in the market, that kind of strategy. Okay, understood that. Sravan, you want to add something? Okay. So basically, when we speak about REITs and InvITs, we have mostly, I think, office themed REITs. We have one retail sort of REIT there, but we're expecting more and more asset classes to sort of come to the market. In terms of diversification from asset class point of view within real estate space, is there a sector that you sort of focus on, be it commercial, be it residential? I'm not very sure, but commercial, warehouses, data centers, these are asset classes which are really up and there, and a lot of capital is flowing. So from that point of view?
Yeah, so unfortunately, as you rightly mentioned, a lot of REITs in India today are only focused on office spaces, right? Unlike go to US, you have multiple asset classes, starting from restaurants to residential to warehousing. You have multiple other options there. Here, it's predominantly dependent on office. But the good part is we have much better diversification available in the InvITs, right? So we have starting from roads, and within roads we have HAM, toll, and then we have the likes of warehouses, we have telecom towers. So that way we look to diversify our portfolio. And also we don't look at REITs in which standalone. We also combine that with fixed income and look to build a portfolio which would also give a natural hedge to itself, right? Like for example, we have a couple of HAM InvITs. So in a rate hike sort of a scenario, we like something like a HAM InvIT, which would provide a natural hedge to our portfolio, right? Which is predominantly fixed income heavy or a REIT heavy. So that way we have enough opportunities right now in the market for us to diversify. And slightly digressing from the REIT InvIT part, so what we also do is, of course, we have things like private credit, which again is largely insulated from capital market sort of movements, whether it's equity or REITs, which are a bit more volatile. Private credit is predominantly less volatile, however, it has its own risk. So that's an asset class where we have a bit of an allocation. And then where we also do things slightly different, at least in our family office, is a largely neglected asset class has always been the high-grade credit in India, right? Which is the asset class which is in a 6 to 8% space, where people sort of just allocate to a corporate bond fund, allocate to an FD, and just assume that will just generate 6 to 7% returns. So what we do in our family offices, that's actually the most active part of our portfolio in the entire family office. So that's where we have an active bond book that we run. The idea is to kind of take calls on duration, take calls on spreads. We look at dislocations in the market, because the advantage you have in a family office is that unlike a mutual fund, unlike an insurance company, you don't have a liability to match your assets with, or you don't have a liquidity that you have to provide to your investors. It's a long-term capital. So that's where we find good dislocations in the market, which we keep actively finding, and that's what delivers higher single-digit to double-digit returns. So that's where we try to generate better risk-adjusted returns. At the same time, it's also a business that we believe is scalable in the sense that from a family office standpoint, we can allocate a much larger allocation to that space, because today promoters might not be keen allocating 30-40% of their fixed income or a REIT allocation to a private credit, but you can always allocate 90% to a strategy like this, because you know what you're getting into, right? So the downside risk is quite limited.
Sure, understood. I think we are short on time, but last 2 questions, and both of you can answer that. If, for example, there is a family which has just sold a business and is sitting on a lot of cash, wants to set up a family office, how would you sort of, construct the portfolio and advise that family in terms of creating a defensive play? I'm sure there are a lot of people here who would want to understand that. So both of you can answer that question one after another.
Very tough question, actually.
And that too in short time.
That is in a short time. If you sold the business first, basically, earlier business used to generate regular income before selling the business. So a significant portion, could be 1/4, 1/3 of the portfolio should be like that. You should keep getting regular inflows.
You're a big champion for regular income.
No, it's not about only champion for regular inflows. Because when you've been putting money, actually,
regular income is
because
needed.
we are not even thinking about liquidity. We are locking a capital. Is 10 years down the line, this VC has raised the money and this is going to be 10x, 20x. We don't know we will be alive or not in 10 years down the line or not. The kind of scenarios we are living, actually. That's a lighter note, actually.
And there is no guarantee it will be 10x
because
or...
you sold the business, right?
Yeah.
Earlier, you were running all your household expenditure, actually, because of that business. So it's become a fashion now in India to sell the business, actually, to run the family office. I don't want to say much on that, basically. Previous session, I've talked a lot, actually, on that. So regular income is very, very important, first, actually. And again, you need to be very, very clear ki what is your mandate. What is your mandate? Whether only the growth at any cost or you want to preserve the capital actually. So when these things are came into mind, then you start, you can say, constructing the portfolio. How much percentage should go into fixed income, how much within a fixed income, what should be AAA, G-Sec allocation, what should be REIT, InvIT, what should be private credit, how much to gold. And when you go into equity, how should be public equity, private equity, early stage, mid stage, growth stage, and what could be the exposure of the offshore. So I cannot give the exact answer. I'm a fan of asset allocation. Always try to, you can say, try to follow asset allocation. But in practical word, it is one of the hard part actually, to follow the asset allocation. I have seen that.
Okay, understood. Same question for you, quickly.
I think Gaurav said right. Anoop said the most important thing, have a IPS, have a mandated clear asset allocation, which suits your asset or your risk profile, go as per that. The topic of safe havens, I will use it in that context. Start with at least 5 or 10% allocation to what we think is insurance, safe haven, hedged, tail risk hedge kind of an event. And also one more element which is critical here, which concerns investor behavior for family offices or anybody else. See, cricket analogy. If all of you are familiar with Rahul Dravid and the era of Virendra Sehwag, they both played together. Rahul Dravid was considered as the wall, safety. You know, he can defend, he can take you for the whole day. Don't expect then Rahul Dravid to have a strike rate of Virendra Sehwag. These are two different beings. A safe haven asset will play a certain role in the portfolio when it will be asked to. But if you think about it, it should also generate post-tax adjusted returns to be upward of double digit. I think that's where you draw a line on behavior part of it.
Sure, understood. We are ending on a good note. Cricket analogy. Thank you so much for your valuable insights and thank you for being a lovely audience. I think let's end it here.